risk management or risk analytics in general, it's expected that they be comfortable with hands-on skills as well. So just having theoretical skill sets is not really enough now. So that was, and if you compare this scenario maybe about 15 years back, then there's a stark contrast now. So maybe 15 years back, you could tell your client saying that, "Hey, we are subject matter experts, we'll not do the technology bit, you hire someone else to do that." But come 2014, 2015, that scenario has begun changing. So consultants or even people who are on their jobs are expected to be comfortable with some bits of technology as well. So of course, your expertise is not expected to be the level of a software engineer. That's different. But you should be comfortable with the technology bit. So that's why the mix of theory and hands-on. And we'll cover, so there will be some bit of math component here as well. So we'll cover only that much math which is required for our purposes. Otherwise, there is a lot of math which is available on this subject. Of course, everything is something which we can't cover, but whatever is relevant to us, that much we'll definitely cover so that it will help us in our hands-on bits as well. And generally, if we talk from a hands-on part, we'll stick to Python and VBA. So why those two softwares? Because those are strong softwares and something which is being used in the industry. So we'll talk a bit about technologies as well as a part of today's discussion. And we'll keep an interactive class. So generally, the approach which I follow is after every slide or maybe after every couple of slides, I take questions because many a times certain concepts which are discussed on one portion might be, or one portion of the presentation will be required somewhere else. So that way, it's always good to have that that interim discussion and then we proceed. So I don't wait till the end for questions. So whenever you do have a question, feel free to raise your hands or maybe put it in the chat box or maybe unmute, whichever way is comfortable. And we'll try and discuss and resolve them in the best way possible. And along the way, I'll give you ideas as to what could be the reference material or any reference books which are generally used by the industry, so that you have an idea of something which you can generally go back to and explore. Of course, maybe during college, you may not have that much amount of time to refer to books separately. So from an examination perspective, don't worry. Whatever you discuss in class, only that thing will come on the exam. But honestly, from a long-term perspective, it's important that you refer to certain reference books because that is what is demanded by the industry. So I would suggest that whenever you get a chance, do explore things. It's always good to know more. And I understand that there will be three periodicals and then the final exam. I think the usual format. So that is something which we'll anyways do over time. All right. So let me share my screen. I've put together a few slides for today's discussion. So the mode of discussion will be, so there'll be a PowerPoint presentation for every discussion. So that will be like a guide for us. And I'll extensively use the whiteboard. So I have a paintbrush which is open and I'll use the whiteboard often. And wherever our developmental activity will be required, we'll use Excel/VBA and Python. So more about that in our coming classes. So I'll just share. Yamir, please go ahead.
Sir, will this in this semester will classes be completely online or will there be hybrid sort of thing?
So for my sessions, it will be completely online. So the 20 sessions will be online for my subject.
Okay.
Okay. So beginning with a gentle introduction. So we try and cover majority of the points today. If there is any spillover, we'll try and complete it in the next class. So did you guys have a very long day today? So how many sessions before this?
Only one, sir.
Oh,
Only once.
okay. So that way, you're relatively fresh. Good. Of course, now today it's not very technical. It's more of what you generally observe in risk management. So it's not a very heavy session that way. Okay. So when you hear the word risk, what could that mean? So how would you like to define risk? Anyone?
Sir, risk can be defined as a deviation from an expected value. For example, if you are expecting a stock to go by 10%, there is always a risk of downside that it will go only by 5% or 10%, sorry, 9% or on negative, in fact.
Correct. Very good. Anyone else would like to give some other interpretation as well? So can we also broadly say it has something to do with uncertainty?
Yes, sir.
Yeah. So generally, whenever you have anything which is uncertain or any asset which is behaving in a certain in some way which we can call as an uncertain manner, we say there is a certain risk which is associated. So a common example to contrast two assets whereby there is risk, whereby there is no risk. So what are the most simple examples of a risk-free asset? So can someone quickly give me an example of one asset which we assume as risk-free?
Sir,
Government
treasury book
bonds.
and gold.
Bank FD.
Bank FD, even simpler. Very good. So something which our parents you invested in very, very often. Of course, we also park some bit of money still in FDs, but yes. So FDs or fixed deposit or time deposit as they call it. So simple example is I just go to my neighborhood bank. Let's say I have 100 rupees with me. I park 100 rupees with them, let's say for 1 year, and the bank says that at the end of 1 year, we'll pay you 6%. Of course, no one is paying 6% these days, but still imagine. So that way, I park 100 rupees today, and at the end of 1 year, I receive 106 rupees back from the bank. So that is how a plain FD or a time deposit works. So in a normal circumstance, you don't expect the banks to default. Uh, so that way, I mean, banks are well capitalized, and we expect that our investments remain safe. So that's why FD and TD are assumed to be generally risk-free, unless the bank goes for a toss, which is a remote possibility. At least in India, that is something which we don't observe because thankfully RBI has a very robust control on banking. So that way we can assume that risk for these type of transactions is zero. Now it's like a fixed income investment. We invest a some amount of money and that is secured. That's it. Now, if you contrast this with a equity investment, so if I invest in an equity stock, then that is naturally assumed to be a risky bet because that way I am exposing my money to market movements. So as the market fluctuates, naturally my equity positions are going to move as well. So that way there is some bit of risk which is associated with something like equity. So I cannot say it's a zero risk. There will be some bit of risk which is there. So that's how, depending on what asset we are looking at, the riskiness of that particular position will keep on fluctuating. So this is in brief the definition of risk, and as you guys rightly said, it's deviation from the expected value, or even from or any kind of uncertainty which creeps in. Now, the role which risk is playing in an organization has become more of a strategic one. So if I can combine point number two and point number four. So earlier, if you observe that risk was considered more as a cost center. So when I say, so we'll talk a bit about revenue and cost functions later on. So, but when you say something is a cost center, it's not really generating any new sales. That is, it's not really generating new business for the bank or maybe for the company. But so that was like a perception, maybe a decade or a decade and a half back, or I would say precisely before the global financial crisis. So if you ask someone around year 2000 that how would you like to classify risk, they would have blindly said it's a cost center. I mean, they're not generating any revenue to us, and they're there maybe for compliance purposes. But come the global financial crisis, that scenario and that outlook has changed drastically. So now risk is seen more as a strategic department for the firm. So something which I have observed in banks as well. So during my time in the bank, what we used to get was we used to have certain strategic investments which the business was looking at from a long-term investment perspective, and they used to take views from risk so that they can make a much informed decision that whether a certain investment fits within the organization's framework. So we'll talk a bit about organization framework and organization policies as well. So because finally that is what drives the overall risk management setup in any bank or any financial institution. So having that broader framework idea is very important. Then we can relate to other nitty-gritties. So things like value at risk or maybe derivative pricing, etc. All of that comes as a part of that broader framework. But through this and maybe the next session, we'll try and get a full view as to what that framework is, so that once we start discussing other nitty-gritties, we are much more comfortable. So now your management is going to look at risk as an enabler, which will help them reach their final long-term vision. Like, I mean, we have vision and mission statements which are defined for every bank or a firm or a financial institution. So one of the examples of vision can be, let's say, a certain XYZ bank wants to become a largest lender in a certain jurisdiction over the next 10 years. So that can be like a long-term vision. So again, for that, there should be a certain direction which has to be followed because they want to become a market leader. So it's not easy. So they have to have certain things which are to be put in place and certain processes to be followed. So that way, whatever strategic or investment decisions, etc., which are being made, inputs from risk are being taken these days. So that way, blindly your business will not do a certain transaction, but they will seek inputs from risk. So that's why risk is seen more as a value adding function now. So in case risk says that there are certain things which they are not okay with a certain transaction, then they put it across to the business saying that these are the points of concerns or these are the possible exposures which we would have to bear with in case we go ahead with such an investment. So those kind of value-added inputs are important so that business can have a much informed view before they can make a final decision. So that's why we say that risk has become more of a value-adding function rather than just being a cost center. Now, talking from a regulatory perspective, we have, so especially from the Indian perspective, we have RBI, which acts as the banking regulator. So all of the guidelines, various types of MPCs, OMOs, etc., we'll talk about that. So these are some things which are done by the Reserve Bank. So is everyone familiar with the Monetary Policy Committee meeting? So have you read about MPC before?
Yes, sir.
Okay. So can someone tell me how many times does the MPC meet every year? So does
Sir,
it
I
meet?
think that differs according to the state of the economy.
Okay.
Sir, is it a quarterly meet?
It's actually
So
bi-monthly.
once in every 2 months,
Exactly.
bi-monthly.
Exactly. Yes.
Yeah.
Once every 2 months. So that way they meet 6 times every year. So when was the last MPC that had happened?
Sir, in this month, I think Feb.
Absolutely. Very good. Yes. So earlier this month, it had happened. So as rightly said, correct. So they have it 6 times a year. So earlier it used to be like a 2-day meeting, but nowadays it's like a 3-day meeting. So again, MPC is important. So do I have anything on MPC? Not really. So we can discuss MPC now. Take it. Well, why this is important? Because this has large scale implications on how exactly your trading function is going to behave. And once, not just your trading, now it's important for your banking book as well. Uh, Again, now we'll talk a bit about trading and banking book along the way, but basically you can say that the bank's portfolio is something which is going to get impacted by the actions of the MPC. So that's why having a clear idea of MPC is very, very important. And can you recollect what was the MPC decision this time? Did they change the rates?
No, sir, the rates has been constant and they have not changed any repo rates as of now.
Correct. Absolutely. Very good. So at the moment, RBI is holding the rate steady. So maybe they're also just waiting for the economy to pick up again, and possibly by the next meeting, they may go in for a rate hike because they had consistently dropped rates over the last 2 years in order to counter the actions of COVID. So in order to kickstart the economy and help to support businesses, rates had significantly been cut over the years. I mean, over the last 2 years. So now gradually rate hikes are expected. So maybe in the next MPC, RBI may come out with something like a rate hike, maybe a 25 bips rate hike or something. And so can you relate the rate hike decision on what exactly happens in the economy? So when RBI hikes rates, what happens?
So credit in the economy becomes costlier and the money supply falls.
Absolutely. Very good.
Credit contraction.
Correct. Yes. Correct. So if I combine both the points together, that means the credit offtake gets impacted. So more of a technical term which we use. That is, if RBI is going to raise the rates, banks are also going to raise the rates. So that way, raising funds from the bank is going to get expensive for businesses. So whenever there is a rate hike, we expect that the overall loans which the bank is going to do, and that loans are going to get expensive for businesses. And during COVID times, they have consistently cut rates so that banks follow suit and they are able to offer loans at a cheaper rate because they want to support businesses and the broader economy. So that's why the rate cut had happened. Also, I mean, decisions from MPC are important from a long-term investor perspective as well. So even globally, investors keep a close eye on what the MPC does because India being one of the important investment avenues, even for global investors, whatever decisions are done by the MPC, that is something which has an impact on the behavior of foreign investors as well. So again, when you talk from a MPC reports perspective, so there is a minutes of the meeting document which immediately gets published on RBI's website on day 3, whenever MPC is announcing the results. So at that time, there is always a special mention about inflation. So can you guess why they spend so much time talking of inflation? Why there is so much importance given to this quantity?
Sir, because every economy wants to have a mild inflation, which is good for economic growth. But
Okay.
if the inflation increases a certain limit, then it can have consequences, and it goes down below a certain limit, it again
Correct.
has consequences.
Correct. Good. So technically, can you relate this with a certain term? Because you guys are from economics, so you'll be familiar with this. So technically, can you relate this? So it reduces something. So what is that something?
Sir, value of money.
Exactly. So just putting it the other way, it's purchasing power of the money. Good. Yes. Uh, because whenever we say, let's say today I'm able to purchase, or let's say maybe 2 years back I was able to purchase a certain asset, or maybe I was able to purchase 3 units of an asset for 100 rupees. Now today, let's say I can just purchase 1 unit of the asset for the same sum of money. That means I can say that inflation has risen over time, because now my 100 rupees is able to purchase only smaller units of quantity as compared to what I was able to do earlier. So that's how you can compare inflation as well. So again, this is like a lagged indicator which comes in. So you have CPI numbers which come in with a lag of 1 month. However, again, it's an important point which is tracked by banks and global investors as well. Because the thing is, inflation will eat into the overall returns for a certain asset. So let's say there is a global investor and they want to park money in India. Then whatever is happening in the Indian market is going to have an impact on their investments as well. And inflation happens to be one of that components. So if inflation rises, then that will have an impact on the returns of their assets in India, which is finally their investment portfolio, isn't it? So even they are concerned about inflation numbers. So you'll observe a clear mention of inflation in the MPC minutes of the meeting always. So generally RBI has a 4% plus or minus 2% limit which they set on inflation. So they have a certain window which is given. So that threshold, if it's breached, then RBI may have to take a certain drastic action. But over the years, that breach hasn't happened actually. So that way, RBI didn't have to take drastic steps. But if yes, it will take certain drastic measures to tame the inflation, because inflation has an impact on the overall economy as well. Also, another important document which comes out with MPC. What is that document? So if you see on RBI's website, there are two documents which get hosted
Sir,
after
the rate,
MPC.
the expected rate of economic growth which the RBI is expecting.
Okay. So another document. So there is one which we call as statement for developmental or the development policies from the RBI. So what RBI does is it always tries to have some kind of reforms which are there in the banking system, so that it can enhance the overall banking framework. So at the end of MPC, you'll see another document. I don't recollect the exact name of the document, but there is a certain document which talks about the possible enhancements which RBI intends to do in the near future. So that is another thing to watch for. So whenever you're listening to MPC minutes on CNBC, I would always advise that visit RBI's website and generally download the MOM and this statement of developmental policies, and generally go through them. You don't have to memorize them, but at least having an idea as to what the regulator expects, that is something which always helps. Next is another action which RBI frequently does, which we call as OMO. So is everyone familiar with open market operations?
Yes, sir.
Yes, sir.
Okay. So what is the main purpose behind open market operations?
To
So why does
control inflation by, yes, sir, by
correct,
the RBI, to control inflation, it is actually used by the RBI, sir.
correct. So maybe if I go slightly further, can I say that they are trying to control the amount of money or amount of funds which are floating in the banking system? So would that be a right way to put that?
Yes, sir.
Correct. So through OMO, what the RBI tries to do is it tries to maintain or it tries to control the liquidity in the financial system. Now, liquidity has a very close relation with inflation, as our friend rightly said. As liquidity rises, that implies that there may be more amount of funds in the hands of people, and more amount of funds will always stoke inflation. So RBI will always try to maintain that inflation number up to a certain level. So open market operations is one of the tools to do that. Other thing is the policy repo decisions. So repo and reverse repo numbers which come in. That is something which RBI does as well. So these two are popular techniques which the Reserve Bank does in order to maintain the overall well-being of the banking system. And I think RBI is playing a very important role in the overall stability of Indian banking, because they are, yes, I mean, at times they are hawkish and they are very, very careful. But I mean, thanks to that, I mean, we were able to absorb the 2008 shock in a much better way, because we did not have too many exotic products which used to trade. So that way we were protected. And RBI, I think, is doing a fabulous job in ensuring that the overall banking system flows smoothly. Of course, but with that, RBI comes up with newer reforms all the time. So any key reform which you can think, or maybe let's talk about reforms in one of our subsequent bits. So there is one section which I want to talk about that as well. Then SEBI. So SEBI is our capital markets regulator. So whatever happens on our regulated exchanges, that is something which is governed by SEBI. So SEBI also gives out guidelines, investor protection, etc. Also, growing importance of risk to cope with innovations. Now, innovation is something which you will commonly observe in the financial services domain. So that now finance domain is no stranger to that. So your innovations could be towards new products, new strategies, new methodologies, etc. So that way, if you have new products and new strategies coming in, naturally your risk systems also have to be upgraded, isn't it? Because if you're using a risk system which is close to 20-year-old and you're trying to have cutting edge products now through which you're trying to, or for which you're trying to apply the same risk framework, then it will be insufficient naturally. Because if there are enhancements on the product side, naturally the risk framework also has to get enhanced. So things like AI, machine learning are gradually making inroads into risk as well. So we'll talk a bit about that along the way. So that's how risk framework is also getting robust over a period of time. Now, talking of a few types of risks. So I've mentioned the ones which are most popular. So first is market risk. So when I say market risk, you can imagine this is the risk about understanding what is the fluctuations in my portfolio because of the changes in various risk factors in the bank. Now, why I call them as risk factors is these are the components which are going to drive the overall risk of my book. So imagine a very simple example. Let's say I have government security. Let's say a GSEC bond. So that means any changes. So which is that risk factor which a government security is exposed to?
Interest rate risk.
Absolutely correct. So that way, any fluctuations in the interest rate are going to have an impact on my investment in the GSEC bond, which I'm holding on my portfolio. So that way, this is what I call as a risk factor, because the movements in the risk factor will have an impact on my holding, which I have in the GSEC as a part of my portfolio. So this is technically also, I mean, technical name is risk factor, but you can imagine this is just like a market parameter. So any fluctuations in this market parameter impact my position. So that way, tomorrow, let's say I have a very active FX option book, then I would want to have FX as well, which is incorporated as a part of my framework, because movements in FX will have an impact on my options position. Then tomorrow, let's say my traders want to transact in commodities, then commodity price levels is also something which I would want to keep a track of, so that I'm able to capture the risk of fluctuations in commodity prices on my portfolio. Inflation, credit spread risk, etc. I mean, I've just taken a few here, but depending on what type of product you have on your book, you'll be exposed to different types of risks. So this is in brief what we call as market risk. Next is credit risk. So credit risk could be most common example of credit risk can be a default risk. So when we say default risk, it can either be complete or partial default. So for banks, especially, credit risk is something which is very, very important, because the core business for banking is lending and borrowing of money. That is, they borrow money from people like you and me. We park our money either in a savings account or current account, and then bank is going to use those funds in order to do lending to businesses or entrepreneurs. So that way, the core business of the bank is borrowing and lending of funds. And what is the technical term which we call for the difference in this action? Something which the bank earns.
Is it a spread, sir?
Yes. So some technical name which we give for that
Net
spread. That is
interest
correct.
income.
Correct. Yes. Net interest income, net interest margin. Very good. Yes. So the bank will borrow at a certain rate and it will lend at a certain higher rate. And whatever the difference, that is the net interest income for the bank. Correct. Good. So now we know that whenever bank is engaging in any lending activity, it is naturally an exposure for the bank, isn't it? Because imagine that you are lending money to someone. So there is always a risk that that someone might default. So one example can be, eh, before we start earning, our parents give us certain pocket money every month. So that my let's say my parents have given me 100 rupees today, and they say that you have to survive a month on that. And let's say 30 days in the month have passed, and imagine it's a 31-day month. So one day is still there to go. But my best friend calls me and tells me, "Ki, I mean, I'm short of funds and I need 50 rupees to purchase something. And I promise that I'll immediately return it to you when my pocket money is reimbursed in the next month." So that way, fine. I mean, I'll say, okay, I mean, he's a friend, so I would give him the 50 rupees which I have surplus. But again, when I do that kind of a lending, always at the back of the mind, uh, I'll have a worry, right? I'll be skeptical that whether my money is actually going to come back. So actually, that is the basic understanding of credit risk which has been imbibed into us over the years. So that is the exact same logic which banks do as well. Only thing is, this is at a much higher level. Like, our pocket money is of a small quantum, but imagine from a bank's perspective. Imagine that a customer comes up with a requirement for 50 crore borrowing. Then 100 rupees versus 50 crores. That's a stark jump. And for this, bank has a comprehensive credit analysis which has to be done, because without having that kind of analysis done, bank will not be comfortable to advance that much sum of money. So, and the main reason is bank is scared that they would have to face default from the customer. So tomorrow, if the customer says that I don't have the money to pay back, and that's a default for the bank, isn't it? So that's like a loss for the bank. So that's why credit risk is something which takes into consideration things like default risk, credit downgrade risk, etc. So we'll talk a bit about credit ratings, credit downgrades in our coming sessions. Next is operational risk, or ops risk as we call it. So things like systems risk, human intervention risk, cyber attack risk, ransomware risk, catastrophic risks, everything is what we call as operational risk. So these may not be may not be exactly something which you call as quantitative in nature. They can be natural disasters as well. Again, that's operational risk, like something which has an impact on the business continuity for a bank. Now, take an example of COVID. Now, those banks who did not have a good digital footprint, they would have found it immensely difficult to tide over the last 2 years, because everything had went online. So those banks who were at the forefront on their digital journey might have definitely prospered, but others would have found a tough time. So again, these are things which we try to manage through operational risk. So when you talk from a bank's perspective, these three are very, very important risks, which we talk also from an overall capital adequacy perspective. So we'll talk a bit about capital adequacy in one of our subsequent classes, where we talk about capital adequacy and various components which get into things like capital charge, credit value adjustments, etc. So request you to hold on till then, and we'll talk about it there. Then there is liquidity risk. So this is something which we generally study along with market risk. So why we do that? Because liquidity risk generally manifests itself as a price risk. And something which manifests itself as a price risk, we generally try to study along with market risk. Because if you recollect, when we spoke about market risk, I mentioned that movements in the risk factors which are impacting the overall value of my position. So I can say that that's also the pricing of my product. So if a certain product is illiquid, that naturally has a certain risk which is associated with it, isn't it? Because something which is not liquid in nature, it will be difficult to offload that product. So let's say I have a certain asset today and it is a illiquid product. And if I want to offload the asset, I may have to take a capital hit. because there is no active market for that. So I need some way to, uh, I need to basically factor in that cost when I decide to sell the asset. So that is like a liquidity risk which I hold. Next is now these two are more of non-quantitative risks, I would say. So compliance and reputation risk. So again, compliance and internal audit team, they work very, very closely. So they are like the first line of defense for the bank. So things like internal audit procedures and processes, and also ensuring that the bank is following every compliance guideline which comes in, because the cost of non-compliance is very heavy. So no bank wants to incur that. So compliance risk is a significant risk which gets taken care of by the internal audit and the compliance guys. And then you have the legal side of risk, which is a reputational risk. Because as we know, reputational risk is very, very important, because reputation is something which takes a very, very long time to build, and you can destroy that in a few weeks. So from a bank's perspective as well, having a good reputation is important, because unless they have a good reputation, people are not going to trust them with their funds. And if people like you and me say that a certain bank is unsafe, and we say that we will not park money with that bank, then naturally that bank is going to have lesser amount of funds to advance to businesses, which will have an impact on their core business model. So banks are very, very careful as to how exactly their reputational risk framework works. Yeah. So these are a few key types of risks. I'm sure there will be more risks as well, but these are the few key ones which we generally study. So any questions on this?
Sir, I have a question.
Mhm.
Sir, don't you think that reputational risk basically doesn't matter, because since RBI is ensuring that all the amount, I guess there's a limit approximately towards like 2 lakh or 5 lakh, that
Correct.
that sum will be secured. So like it doesn't matter if I put my money in HDFC or AU Small Finance, if I'm not wrong.
Correct. So are you taking the insurance exams by any chance?
For me, no, sir.
Okay, okay. Because the point which you mentioned has to do with what you observe in the insurance business as well. So that is also what we call as a moral hazard risk. So very good. So it's a good point. So what we say is how do you explain a moral hazard risk? So if I give a simple example from the insurance business. So let's say that I have automobile insurance, and on that, let's say I have theft insurance. So let's say if my car gets stolen, insurance company is there to step in, and I can then use that money to purchase a new car. So whenever I purchase that kind of theft insurance, that tends to make me maybe slightly reckless, I would say. So that way, I may not want to park my car correctly, or maybe I may not want to park, maybe lock it correctly. So even if it goes away, I still have something to take care of, right? Because my insurance company is there. So that is like a moral hazard risk. So something similar happens on the banking side as well. So this is something which investors have to be careful. So people like you and me, because we know that RBI is there to, so basically DICGC, which we call it the deposit insurance. So deposit insurance is there to protect bank deposits up to 5 lakh rupees. So those are guaranteed by them. But anything beyond that is something which we can lose. So imagine that you are holding 10 lakh rupees in a bank account and the bank goes bankrupt tomorrow. Then DICGC will compensate for 5 lakhs, but beyond 5 lakhs is something which you will stand to lose. Now, many times what happens is, now those people who may not be very familiar with the banking space or from the capital markets in general, they'll say that fine, we have parked in the bank, the money is safe. But that should not be the perspective from a practical circumstance. You should always look at the overall way in which a bank functions. So yes, RBI has a very strong hold on the banking business. That's correct. But still, from a investor or from a depositor perspective, you should be careful about where your money is parked. Because finally, if things go wrong, even if the regulator can't save a certain bank, then you stand to lose your hard-earned money. So that's why, I mean, reputation risk is something which borrowers should always look at. And that is where, because of the DICGC insurance, this is something which gets overlooked. But from a broader perspective, this is something which has to be considered. But does that make sense?
Yes, sir.
Okay. Yeah.
So,
Yes.
so we just discussed that, because of the interest rate fluctuations from the point of the central bank itself, like the repo and reverse repo rates, we see a change in borrowing and lending interest rates for us as the final customers. So, sir, when we take a long-term loan, it's over the years and the rates are fixed at which we borrow. So, how does bank generally tend to mitigate that kind of a risk?
So generally fixed rate loans are rare. So if I talk of example of say a housing loan, then generally housing loans are floating rate. So of course there is an option for fixed rate, but fixed rate is generally high. So it's prohibitively high, which generally people don't go in for. But generally you'll observe that they are floating rate loans. So I think the first part about the rates, generally you'll observe long-term rates are floating in nature. Now, for mitigating those kind of risks, banks have a comprehensive framework, which you call as the IRRB framework, which you call as interest rate for the banking book. So that is something which they try to manage because loans, overdrafts, etc., everything is a part of your banking book for which you want to have some kind of a mitigation technique. So we'll talk a bit about that when we talk of ALM. But generally, to give you an idea, banks have active teams, which we call as assets and liability management team, which are there to manage the balance sheet position. Because finally, whenever we are talking of such transactions, let's say a loan or something, it's just like a balance sheet transaction, isn't it? Finally, it will have a larger impact on the balance sheet. So maybe we'll talk a bit about ALMs in one of our subsequent slides. So at that time, we'll discuss things like duration, gap management, etc. So till then, request you to hold on to this point, if that's okay.
Sure.
Yeah.
Thank you.
Okay. Next is a generic risk process. So, and this is a type of process which you can apply for different types of risks which you have just studied. Now, here I've just taken an example of market risk because I'm talking of market prices here. But essentially, a similar approach. I mean, the steps which are given in blue, that are the same steps which will be applied for any type of risk. Yeah. So firstly, defining what exactly we are trying to manage. So this is like the very first step. So what is it? I mean, what is it that I'm trying to understand? So if I'm talking from a market risk perspective, I am trying to look at what are the risk of losses on my portfolio because of the movement in, I would say, market prices or market factors or market risk factors. So finally, market risk factors will have an impact on my market prices. So that is my primary concern whenever I'm talking from a market risk perspective. Any movements in interest rates, volatilities, FX rates, etc., how exactly are they impacting my portfolio? That is the what is it question, or what is it that I'm trying to manage. Next is identification. So once I know what I am trying to manage, I have to start looking at what risk factors I have to take care of in order to manage my portfolio position. So can anyone guess why this risk identification is important? What will happen if this identification is incorrect?
So we would be blindsided basically without knowing where the risk coming from. Like for example, in 2008, they miscalculated subprime crisis and it blew in their face. Basically,
Correct.
that was a major fiasco there.
Correct. Yes. Good. So that is one side. Yeah. Sorry. I mean, Ayush, you also have some point.
Yes,
Yeah. Please go ahead.
so basically there's a funda which means the more the risk, better the return. Okay, so we need to get return from our assets. So if the risk is kind of a calculated risk, then it's good for us to take that risk. And if it's not getting calculated or something like that, then it will turn out to be a problem in the future.
Correct. Correct. So yes, so both are correct points. I mean, if we miss out on a certain risk factor, so imagine that I have a certain options book, and if I forget to use volatility numbers as a part of a risk metric, then naturally it will have a large scale impact on the way in which my risk framework works. So that way it is dangerous because if I miss out on a certain risk factor, I'll end up not using it in my analysis, which will not give me a true picture of risk. So that is one side. Can you think of some other reason as to what will happen if or what will happen if the identification is incorrect? So this is correct, but anything more to this? So I'll give you a hint. Think from a system optimization perspective.
So,
Yes.
so once we identify a particular risk, we try to plan accordingly. Like we plan to mitigate it in a way. So if
Correct.
we don't see where the risk is coming from, your basic mitigation actions are headed towards wrong direction.
Correct. So yes, that is correct. So I mean, that we it will end, if we miss out on a certain risk component, then yes, I mean that is definitely not getting captured. But maybe let me give an example. Let's say I have a plain vanilla bond portfolio, and let's say my traders say that this is only the thing which we want to have in the book. But I say as a part of risk management, I want everything. I want interest rates, spreads, FX rates, commodity prices, maybe even some other inputs. Let's say I map all of these things in my system. So how would it be from a system optimization perspective? Will it have an impact? So basically, I'm trying to balance my system optimization with my risk framework. So imagine a plain GSEC portfolio, but I have mapped everything. So will it have an impact from the overall optimization or maybe the system processing perspective?
So can I try?
Yes, yes,
Um,
please go ahead.
Simple language, I think it can simply cost you more. There's an opportunity cost. Second, you might enter into so many positions which are not even required. So in terms of an actual cost and an opportunity cost.
Correct. So maybe just extending his point, yes, he is right. So the thing is, if we are capturing some factors which are unnecessary, imagine that I have just government securities and I don't need to, I mean, I'm not going to invest anywhere else. So I know for government securities, the only risk factor I'm exposed to is interest rates because it's a GSEC portfolio. I don't have to worry about anything else. But the thing is, if I start sourcing other things which are honestly not necessary for me, that is going to put a overload on my system because the way in which these enterprise risk softwares work is they drag all the market data on a end of the day basis and they use it for their processing. So now if I don't optimize my processes for fetching the data, that is going to take a longer time for fetching the data, one, and next is maintenance of data. Now, some data which I'm never going to use, why should I really keep that in the repository? Because that will result in my system not being optimized. So always try to map your risk factor in such a way that they're exactly in sync with your portfolio. So tomorrow, yes, if my trader says that we want to start transacting in FX forwards, let's say we want to trade forward, then yes, I will immediately map FX forward exchange rates as a risk factor. So maybe depending on what my portfolio is going to shape, I should identify and keep only those risk factors in the system so that my overall technology framework remains optimized and it remains a light framework. Because always remember that when you're talking from an enterprise risk perspective, don't think only from risk management. There are various other teams which are going to use the same system resources, and system resources are always limited. So always try to optimize so that whatever system processing power gets saved here can be used somewhere else. So that's why having optimization or proper identification will help you streamline and optimize your processes in a better manner. So does that sound reasonable?
Yes.
Yeah. Okay. Now that we have identified things, comes the measurement part. So we need something to measure how much risk we are carrying. So maybe if you're talking from a market risk perspective, value at risk models can be one of the ways to measure risks. So again, this is one of the most popular models which is used. So we'll talk a bit about value at risk and we'll also Sorry, guys, I got disconnected. Some problem with the net connection. I just switched to hotspot. Yeah, let me just reshare screen. My apologies for that. So I think I lost you on the monitoring bit. So when we say monitoring, it is mainly the MIS reports, or what we call as management information system. So it can either be used for regulatory reporting purposes, or it can be used for management reporting, which is your daily reporting which happens. So that way you have a continuous check on what is happening in the portfolio, and that is managed correctly. So this is what we call as the monitoring step. So broadly, risk management can be considered as a combination of these 5 steps. So applied for any type of risk, but you'll be able to fit it inside this framework. So any questions on this?
So we lost you at VR models.
Oh, okay. Oh, my apologies. Okay, so we haven't discussed about control, is it?
No, sir.
Okay. Sorry, I thought because there's this small light which is next to the camera which went off in that monitoring step. So I thought we might have disconnected there. All right. So let's talk a bit about control quickly. So when we talk of control, that means we have identified what the risk is. We have already measured the risk as well. We have a certain model which is there, something like a VAR model. Now we need some process or a certain framework which is going to help us control the risk, because risk control is also equally important, right? Without that, we cannot manage the risk. Here we are just measuring it, but something to manage the risk. So that is driven by organization approved policies, processes, limits, etc. So in one of our subsequent slides in this presentation, we'll spend some time understanding board approved policies, because if you join a bank or a financial institution in the next few months, you'll be required to refer to these policies as well, because these are the key things which are required for defining how the risk framework looks like. So we'll spend some time understanding the key policies. Of course, now these are bank specific. So depending on which bank you join, there will be some changes in the policies, but broadly, the content of the policies will not change much. That will remain more or less similar. So we'll spend some time understanding that. Monitoring part we have just spoken. So that way, this is like a generic process, I would say. So anyone has any questions on this?
Sir, can we please go back to VAR model?
Yes. So about the VAR model, we will be spending some time understanding the technique for VAR models. So VAR stands for value at risk. So what is value at risk? How do you measure it? Don't worry now. We have a separate module for that anyway. So we'll maybe in a few weeks we'll talk about VAR. But why we require VAR models is because we have identified what we are trying to do, or we are basically, so for this example, we are looking at risk factors or market prices. Next is we have identified the optimal set of risk factors which my portfolio is exposed to. Now, once I have done that, I need some way to quantify how much is the risk which I am carrying on the book. And for that quantification part, I need a measurement technique, something like a value at risk model. So that way I have a certain number, that is a quantification of the amount of risk, because finally, if I have to monitor it against a certain value, so let's say I have a certain limit which is defined for the maximum risk which I can call, which I have to follow. Then I need to have some number which I can compare against the benchmark. So that is what something like a value at risk model or any other model does for us, which is quantifying the amount of risk of my portfolio, so that it helps me in my control and monitoring process. So does it sound okay?
Yes, sir.
Okay. Okay. So we are at 7:30. So do you so generally do you have a break for like 5 minutes between between a
Yes,
2 hour
sir.
session? Okay.
Yes, sir.
Okay. So let's break for 5 minutes and we'll resume.
Okay, sir.
Hi guys, can we resume? Is everyone back?
Yes, sir, we're back.
Okay, okay. So giving you an idea of organizational structure for a typical bank. So imagine that this bank operates within one jurisdiction. So let's say within one country. Now, if it's a global bank, naturally you'll have some additional divisions. So let's not worry about that at the moment. Imagine that it's a bank which is operating within a certain country, which is typically a structure for any bank which you'll find in India. So at the top, you have board of directors or BOD. So can you think of the role which the BOD plays? So some things which might have been covered in your corporate finance. So did you have corporate finance as a topic as well, or was it a subject which was covered earlier?
Yes,
So
sir.
we started last year.
Okay, okay. So maybe you will find some pointers there. Now, why do you require a board of directors? What's their purpose?
So the board would operate more on setting a direction to which the bank would head. And then it's
Okay,
the role of the then it's the role of the CEO and the rest of the management to actually work their way towards that end goal.
okay. Any other purpose which the board uh, conducts?
Making policies and decisions.
Correct. Okay.
That
Anything else?
basically, in short, everything like if company would expand or not, what are its goals, the targets for the future.
But that is something which will be decided by the management, which something the board will just approve. But something very important which the
Dividend.
board does.
Sir, it reflects the stakeholders' ownership in the company, right?
Yes, can you slightly elaborate that, please? Yes, you are right.
So the stakeholders would work on putting in place directors who would reflect their best interests, right? So it's a mode
Correct.
of governance also. So it's more of governance.
Absolutely. Very good. So that was the word I was looking for. Very good. Corporate governance. So correct. All good points and all valid points. So starting from the first, yes, they do set a direction because finally you have a certain long-term vision which is to be accomplished, and board of directors are generally there to support that vision. Then there are board approved policies and processes which we'll talk about anyway in our next slide. So they come out with certain organization wide policies which are adopted and which are used by the bank. And thirdly, corporate governance, or so basically something which is very important from any stakeholder's perspective. So be it a borrower or be it an investor as well. Now, any bank which has a very robust corporate governance framework is something which investors will also be comfortable to invest in. Because whenever you have a corporate governance framework, that implies that the board of directors are there to protect the interest of investors. Because this is because when you talk of things like running a bank or even a mutual fund, etc., you always have a principal and agent problem because you have the bank management who has much better view of the way in which the business is running because they are running the show day in day out. They know what the thing is. Whereas if we talk from investors or from other stakeholders perspective, they are not involved in the day-to-day activities because it's not expected that they are involved. So they naturally have some amount of, so there's always a natural information inefficiency which is there. It's always a skewed information. Your management will know something more as compared to other stakeholders. So at that time, in order to protect stakeholders and to bolster their confidence that yes, the bank is working in their best interest, you require a very robust CG framework or a corporate governance framework. And one way to do that is having more and more independent directors on the board. So that is what we call as non-executive directors. So a non-executive director is the one who is not involved in the actual day-to-day activity of the bank. So generally, you'll observe that most banks and financial institutions will push for more number of independent directors on their board. And whenever stakeholders see that the proportion of independent directors is high, they will always be more comfortable with that board structure. So that's how the overall corporate governance framework gets driven. So having a very robust framework is very, very important. Next is committees of the board. So now we have board of directors who is doing all of these activities. So why do you really require committees of the board? I mean, you can just move from board of directors to CEO, right? So why have this additional layer and why pay this additional salaries to people? Why is it required? So why not directly jump from year to year? Why go through this route?
Sir, because the committee of the board represents a specialized group of individuals whose skill sets are niche, or we can say specialized and suited for banking. Board of directors can be influenced by someone, say, who holds a large percentage of stock. He may appoint a director, but the director may not hold the adequate possession, adequate skill set. So,
Correct.
committee of board exists to oversee that right people are in charge.
Correct. Absolutely. Very good. So any committees which you have heard of before? Either me or anyone, yeah. Any committee names which you can remember? Okay. So a few popular. So just to add to Mihir's point. So the idea of having committees of the board is now BOD is something. Those set of people who are not involved in the day-to-day activities. They set the tone at the top level, and that is something which is expected to be followed by everyone within the bank. So for that, you require someone who is actively managing the show. So for that, you have committees of the board. So board has entrusted them with the responsibility that they ensure that whatever has been decided at the board level or something which is board approved, that gets followed by every layer within the bank right up till the bottommost layer. So that way, ensuring that the board approved policies get incorporated and get implemented is what the committee of board do. So a few popular board committees could be a risk committee, then you could have an audit committee, you could have a compensation committee, etc. So that way, as you rightly said, you have people with specific skill sets who are there to monitor those specific things. So you have people who understand risk management who will be a part of risk committee. Then you people maybe from chartered accounting background who understand audit in and out. So they will be a part of, let's say, audit committee. Then maybe you could have HR specialists who have spent some time in the industry and know well about how a compensation structure should be designed and it should work. So they may be a part of, let's say, the compensation committee. So that way, to ensure that board approved policies get translated into practice, you require committees of the board. Then you have MD and the CEO. So the captain of the ship who is there to ensure that the bank gets steered in the right direction. So things like deciding on strategic goals and objectives and maybe chalking out the way to reach that objective. That is something which MD and CEO is expected to do. So this is like the top layer. Now below you have different departments which are there. So I have shown a division between these departments. So why have I shown the division here? I could have shown the division somewhere else, right? So I could have shown the division maybe here, but I've shown it here. So what is the reason behind drawing this red colored line here?
So is it a divide between profit centers and cost centers or value added centers or something?
Correct. Yes, absolutely. So technically, this is what we call as a revenue function. And also this is what we call as a support function, support oblique value added function. So correct. I mean, that's why we have segregated these separately. So when you say a revenue function, these are the divisions or departments within the bank who are there to bring in new business. That is, their role is to drive the top line growth for the bank. So getting new customers and generating the required profitability on the businesses is what a revenue function's responsibility is. Now, of course, revenue function is large because finally you require the bank's business to thrive and to increase in size, right? So you have specialists from various domains. So you have treasury, which you also call as the front office, or also what we call as the GMG or Global Markets Group. So this is there to operate the front office or the trading business of the bank. So things like dealing, treasury sales, balance sheet management, that is ALM, etc., hedging, margin deals, etc. Now different activities which the front office does. So there could be various reasons whenever a front office transacts. They could either do it for hedging a certain position or they may want to do it for trading perspective. So based on how exactly they see different strategies or different situations in the market, they may want to take certain set of actions. But that way, it's a very, very active department. So GMG is something which will always be at the forefront whenever you talk from a trading book perspective. Someone has raised a hand, is it? And I got an update. Yeah, Mihir has raised a hand. Yeah, Mihir, please go ahead.
Sir, I just wanted to ask, sir, why is risk head given on support side? Like, why is it not, say, joined with treasury or commercial or embedded with the other heads?
Because risk, if we say, the risk is not really bringing in new business, right? So those teams which are getting in new business for the bank is something which we try and classify as revenue functions. So risk may be there to decide if a certain investment opportunity is right or wrong, but getting the investment opportunity is not the business of risk. So that's why I have moved risk toward the support function and not the revenue function. Yeah. Okay. So what is GMG? So I mean, any of you who join the trading divisions in a bank will be a part of the front office. Then you have the CIB division. Either so many times commercial and retail banking, or some banks have a combination, that is commercial and retail banking plus investment banking, which you call as the CIB practice. But talking from a commercial or retail banking perspective, things like project financing. So let's say a customer comes up with a requirement for borrowing money for a certain long-term project. That can be project financing. Then there can be consumer financing. So consumer loans are also a large portfolio for a bank. So it can either be retail or wholesale customers. So that is something which we do under consumer financing. There can be corporate borrowings, which can be done as well. So something which gets covered under commercial and retail banking. Next is iBanking. So investment banking implies various activities like supporting companies on IPOs or book running processes, etc. Then mergers and acquisitions advisory, any kind of strategic debt or equity investment which a bank might be looking for. So all of this thing might be covered inside investment banking. Most banks will have a combination. It will be a CIB practice. So one example which comes to my mind is JP Morgan in India. So JPM in India has a CIB practice, which is commercial and investment banking. So most banks follow that model. Then you have primary dealerships. So is everyone familiar what a primary dealer does? So did you guys have anything on fixed income before this? Or maybe did you have a separate?
Sir, primary. So in the context of GSECs, a primary dealer is a dealer who is authorized to directly purchase from the RBI.
Correct. Absolutely. Very good. So was this covered as maybe a part of your earlier subject in maybe capital markets or maybe fixed income?
We had it in the first semester, sir.
Okay. But good. Yes.
So,
Yeah.
IBF has not done it in the previous.
Okay. No problem. So I'll give you an idea. So whenever there is any discrepancy, please let me know. So this is perfect. So that way I know that if something is not covered for the other branch, I'll cover it along the way. So the main role which primary dealers do is they actively participate in the auction of government securities. So for the batch for whom primary dealers was not covered, are you guys familiar with what is the auction of government securities?
Yes, sir.
Okay. So RBI, as we know, conducts these kind of auctions periodically. So, and they do it because they have to raise money on behalf of the central government. Now, union government can't go and raise money by themselves. They have to do it through the RBI. So RBI does periodic auction of government securities. Now, in that auction, there are certain entities which participate. And we have primary dealerships. So these are also called as PDs for short. So PDs are those entities who participate in RBI auctions to ensure that the auction becomes a success. And of course, for that, they receive a fee from the Reserve Bank as well. The idea is whenever RBI is raising money through the auction market, it expects that the entire chunk gets subscribed. Because finally, that money is raised for the central government, which will use it for various public expenditure and for public welfare purposes. So RBI will always push for that auction becoming a success. So for that, they appoint entities like PDs who say that we commit to purchasing certain portion of the auctions. So they give a commitment that whenever this auction comes in, we are purchasing so much amount of quantum. So that way you have different types of primary dealerships in India. So you can either have a bank PD or you can have a standalone PD. So if I recollect, there are close to 16 or 18 cumulatively primary dealerships in India who participate in various government auctions. And they ensure that the auction becomes a success. That is, they ensure that that much or that much quantum of funds get subscribed, and RBI is able to raise money for the government of India. And finally, once they purchase these assets, they will be finally transacted as a part of their portfolio, because primary dealerships, they will be engaged in purchasing from the primary market, which is the auctions market. And once they procure those securities, they will sell it in the secondary market. So now then it's their prerogative. Some portion they may want to hold on their books. Maybe the other portion they may want to transact or sell to the broader market as a part of the secondary trading. But primary dealers ensure that there is ample amount of demand which is there in the primary auction segment, and RBI auction becomes a success. So this is like a primary role which PDs play. So is this okay? Any questions on PDs bit? Okay.
So this is similar to underwriting of the shares, right?
Something similar, yes, but of course, it will be a separate asset class. So shares will be more on the equity side. This is on the debt side, but something similar, you can say, yes.
Yeah.
So,
Sir, following up on the previous question, like underwriting if the suppose number of shares are not subscribed, the underwriter has to buy them. So in terms of GSEC, is it same thing with it?
So what the PD does is PD will commit that we will purchase a certain quantum of the auction which is going to happen. So that is a commitment which they give. Along with PDs, there are other market participants who transact in the primary market as well. So when you look from an auction or the success of the auction perspective, PDs play a large role in that, because they subscribe to a certain quantum. So that will ensure that auction is able to become a success and it gets completely subscribed. So that's how we generally look at PDs. Yeah. Also, there is a reform which has happened in the overall auctions market now, or maybe in the primary market. So of late, government is promoting more and more retail investors to participate in government securities as well, because our government securities market is comparatively, I would still say it's in a nascent stage, because we don't really have too many derivatives on top of it. But in order to promote liquidity and in order to attract more and more investors, and also give one more avenue for investors to park their money in, they're allowing investors or maybe even retail investors to participate in the primary securities market or primary auction of government securities market. So that way, gradually we'll experience a larger volume, so that we have more participation. And it's always good to have more participants in a market, because whenever you have more number of participants, that ensures that there is better price efficiency, and also it will push liquidity in the overall space. So that's why this is, I think, it's a great way to promote retail investors from entering such a market as well, something which they did not do initially. So that way, this is like a reform which the RBI has done. So that way, newer reforms keep on coming. So, but this is something significant which had happened a few months back. So I thought it's right to mention it here. So again, along with this, there may be a few other teams which may be classified as revenue functions. So finally, remember that any department which is going to help drive the top line for the bank is what we call as the revenue function. Now we come to the support function. So we talk of risk management. So yes, we have spoken of risk and the processes which a risk team follows as well. So that way, assessment, measurement, monitoring, reporting, modeling, etc. All of these things get covered by risk. And when we talk from a modeling perspective, generally there are two sub teams within them. So one is what we call as a model development, and other is what we call as model validation. So we'll talk a bit about development and validation in our subsequent slides. So I request you to hold on till then. Then you have technology. Because technology is at the forefront when it comes to any organization, not just a bank. And that way, every bank is becoming tech savvy, because they know that technology is vital for them to survive in this competition. because technology helps them streamline their processes. Also, it helps them improve their overall customer experience. So once the customer is happy, they will stay with the bank for a longer time. So that way, technology is becoming paramount. So things like managing system infrastructure, supporting systems on treasury, accounting, P&L, and analysis, etc. Everything gets handled by the treasury team. Oh, sorry, the technology team. Then you have audit and compliance. So again, as I mentioned, they are like the first line of defense for the bank. So very, very important, because any query which comes through maybe on compliance from either SEBI or from RBI, that will be attended to by the audit and compliance team. And even if it's not to be attended by them, they will always be marked a copy. So if a certain question is specifically directed towards risk management, then it will be routed through the audit and compliance team, because these are the guys who look after the main line of defense for the bank. So they should be in the loop. Then you have HR team. So the main idea of having a good quality HR team is to ensure that they're hiring the right people, and also they're supporting any kind of trainings or enhancing the skill sets, because finally those skill sets are going to be used for the greater good of the bank. So a robust HR team is required. And then you have a CFO group. So we know that CFO within a bank or within any firm it's a very, very important post, a chief financial officer. And that way the activities which a CFO does is huge. So generally you have a team which is there to back the CFO to do all those activities hands-on. So things like financial planning and analysis, or maybe things like capital provisioning, etc., gets handled by the CFO team. So many a times, few activities which are done by the CFO team, risk team works very, very closely with them. But again, most banks will have a small CFO team who is there to support every requirement which the chief financial officer has, and again, classified as a support function. So just like the revenue side, there will be more departments which get classified as support, but these are the key ones. So any question on this structure?
Sir, is it true that the Indian branches of foreign banks mainly do the support functions, and the revenue functions are done in their main headquarters?
So that depends. So if you take an example of, let's say, an HSBC, then HSBC has active India operations as well. So they have firstly they have a banking license in India. So they have a merchant banking as well as a commercial banking license. So for HSBC, for maybe someone like HSBC, it's a mix, I would say. So they have someone who is focusing on the Indian market, so someone like HSBC Bank India Limited. And then there could be the KPO function, which is there to support the global banks. So I think it's that way. Whereas if you take someone like, I don't know, maybe compare Barclays. Now, Barclays doesn't have a very active presence in India. Now, they may be supporting on maybe M&A or maybe merchant banking activities, but they don't have a very active banking network here. So maybe from a Barclays perspective, possibly they would be there to provide support for their global or for their global offices. So I think it depends on. It will vary from bank to bank, I would say.
All right, sir.
So just one more question.
Yes.
So from the looks of it, sir, I would imagine risk team and maybe audit team. These two would always be in the crosshairs of almost every other department, especially the revenue functions, right?
Yes.
So then how does the company go about deciding the limit? Because, if it were only up to the risk team to decide, they would ideally set the limits so high, they would always want to play safe, whereas the marketing function would always be a bit open to taking risk.
Correct.
So then how does the company go about balancing
Correct.
these two?
Correct. So that's a good question. So thanks for bringing it up again. So when we talk of risk policies, we talk a bit about the limit structure as well. So when we talk of the overall capital, or maybe from the risk threshold perspective, we'll try and address that. So can you hold on to this maybe for some time, and we'll discuss it in the subsequent part of this discussion.
Okay, sure, sir.
Yeah. Yeah. So here we talk of the tolerance bits, etc. So firstly, why do we require an organizational policy? That is because a bank is a very large organization. So that way we require some bit of standardization or streamlining of the way in which things happen within a bank. Now, let's say a bank has let's say 20 departments. Now, if 20 departments decide to follow their own whims and fancies, then bank will not run as per expectations, isn't it? Because everyone will follow a certain ideology which may not be in line with the bank's vision. So you require a structure or a framework which is going to decide on the way in which the processes and processes or the way in which activities which a bank does get standardized in some way. Because once there is standardization, then that way things like setting accountability, setting roles and responsibilities becomes very easy. So that's why, in order to have a systematic approach to doing things, we require an organization-wide policy. So without a org policy, things will be haphazard. Then the concept of risk culture, risk appetite, risk tolerance, now all these are related ideas. So let's try to discuss them quickly. So when we talk about risk culture perspective, so this decides, or maybe the risk culture is something which defines the way in which a bank or any organization sees risks. So there may be certain banks who are very aggressive. So that way we say that the culture in the bank is comparatively aggressive. So they go in for aggressive investments or aggressive trading activities, etc. Whereas there may be certain banks who are not very comfortable with that aggressive risk culture, but they would be looking for much more conservative things. So they will say that fine, I mean, we are okay with earning some lower return, but we are not willing to take on higher risk. So that way, that risk culture is something which will reflect across the bank. So the various actions which are done by the bank, that gets reflected on the risk culture. So you'll see generally those banks who have a kind of an entrepreneurial mindset, they will always have more of risk-taking attitudes. Whereas those banks who are slightly conservative in nature will not be willing to take on additional risk on their books, maybe. So that's how the risk culture in every bank varies, and based on the variation in this culture, the overall behavior of the management also changes. Because if you have a very aggressive outlook, naturally the management also has to have certain aggressive steps which it takes in order for the business to grow. Whereas if it's a conservative mindset, naturally you have to balance out that aggression with larger amount of conservativeness from the management. So that way, risk culture is a very broad idea, I would say, and something which you get to see after looking at the way in which a bank does its business. Then there is a concept called as risk appetite and risk tolerance. So I would like to combine these two together and talk about it. So generally for every bank, there is a certain amount of risk which they're comfortably taking, because we know that for any activity to be taken, finally there has to be some amount of risk taken, isn't it? So did you guys have anything on Markowitz portfolio theory, which was covered? So did you have something like a security analysis and portfolio management subject, or something like
Yes,
this?
sir.
Correct. So
We
there
in
you,
had it. I'm not sure about IBA.
okay, okay. But fine, I mean, but generally, is everyone familiar with the risk and return framework? Was that covered for both the branches? So is everyone familiar that we look everything from a expected return versus risk portion?
Yes, sir.
Yeah, correct. So exactly. So we are using the same things. Now, why I said SAPM, because generally Markowitz and these things get covered there. But even if not, don't worry. We don't have to go into Markowitz theory here. But I just want to focus on this risk and return framework. So whenever we look at risk, or whenever we look at any investment or any business opportunity, we always look at it from an expected return versus a risk perspective. And every bank will have a certain upper threshold up to which they are willing to add on risk onto their books. So whenever a bank takes a trading position, or whenever a bank does any lending operation, be it a retail consumer or be it a wholesale consumer or maybe a large conglomerate, they are taking on risk on their books. There are different types of risk. It can either be market risk, it could be credit risk. Also, depending on the way in which the market, way in which the banking industry is going, there is significant amount of ops risk as well, especially things like cyber attack risk, etc. So all of these things get defined within your overall risk appetite. So what the board says is this is the maximum amount of risk which we are willing to take. So so that will set like a threshold or like a tolerance level which the bank's management is not expected to breach, because the board says that we are comfortable with so much amount of risk and we want you to operate only within this much risk. We don't want you to breach this tolerance level at any cost. So that is what we call as risk appetite and risk tolerance. And again, this will change as per the bank. So certain banks could have a higher risk appetite. So naturally, their tolerance for risk could be higher. So they may want to go in for more risky investments or maybe go in for risky endeavors. Whereas for a bank which is much more conservative, they'll have a lower risk appetite. Naturally, they'll not be okay with adding too much amount of risk on their books. So their risk tolerance is also low. So that way, your risk culture and risk tolerance and appetite, they are very closely linked with each other. Because risk culture is very broad, I would say, that you get to see in the overall behavior for the bank. Whereas the actual quantitative numbers which you need for analysis, that is something which you can get in your risk tolerance levels. So your risk appetite will have an impact on how the tolerance levels are going to change as well. So again, something which gets decided at the board level. Next is risk management from an enterprise-wide perspective, or what we say as ERM, or enterprise risk management. So yes, we have specialists from every type of risk which are there to manage the risk of the bank. So we have specialists from market risk, we have people from credit risk, ops risk, etc. However, finally, whenever we say that we are looking at risk management for a bank, we are looking at the entire bank, isn't it? Because whenever a bank fails, that entire bank is failing. It's not one team which fails. So that way, always remember that although we are studying these risks in silos, it is important to monitor risks from an enterprise-wide level. So one example can be your capital adequacy numbers. So when you say capital adequacy, although you may be calculating market and capital adequacy separately, but finally you will be saying that this is the capital charge for my bank. You don't calculate capital charge department-wise. So again, that's an idea of looking at things from an enterprise-wide level. So although things are in silos, they need to roll up at an enterprise-wide level so that your risk gets monitored in a correct manner. Then there's a concept called as risk budgeting. So that way you can either have a view based on various parameters which are linked with your portfolio, or you could have risk-based or risk factor-based risk budgeting as well. So that way, your parameters could be, let's say, beta for your equities, or maybe duration for your bonds, etc. So we'll spend time understanding betas, durations in our subsequent sessions. Or it could be risk factor based. So things like interest rate risk for your book, or maybe equity risk, FX risk, etc. So another facet which gets into the overall policy framework. Now, we'll talk a bit about organization-wide policies, typically which you'll observe in most banks. Now, these are the most common ones which are there. So I've listed them here. So let's go through them. Of course, nitty-gritties are something which will vary bank-wise. So that is something which you'll get to see after you join a bank. Now, again, these are policies which are something which are not available in the public domain. So you will have to be a part of that bank or a financial institution to actually read through these things. But generally giving you an idea of what to expect in these policies that we can discuss. So first is funds and investment policy, or what we call as the F&I policy. So if you ask size-wise, this is the largest policy, or this is the most broadest policy which is there for your consumption. So a fund and investment policy will talk about various things. So it will talk about the list of approved products. So one of the key points in the fund and investment policy is the list of products which the board has approved, which can be used for trading and for investment purposes. Then they can also talk a bit about various type of risk measures which they want the bank to adopt. So based on what kind of risk, what kind of asset class we are looking at, there will be different risk measures which are to be followed. Again, something which you will see inside funds and investment policy. Maybe they'll also talk a bit about those broad level limits. So we'll talk a bit about limits framework now. And when we talk of exposure monitoring, we'll spend some time understanding limits further. But for now, imagine that you have a certain limits framework which has been defined. And that limits framework is in line with your risk tolerance. Because as I mentioned, risk tolerance is a number which will help you to quantitatively manage the overall risk appetite for your bank. So for that, you require limits, and limits are something which will be defined as a part of your funds and investment policy. So you could have limits on bond duration. You could have limits on the maximum trader book size, etc. So we talk a bit about limits in the due course, but again, something which you will find a mention in the F&I policy. Then you have the valuation policy. So valuation policy talks about the different methodologies which the bank has accepted for valuing its positions. So it could either be maybe valuation of bonds, valuation of bank loans, maybe valuation of overdrafts, valuation of derivative products, etc. Now, all of these will be clearly mentioned in the valuation policy so that there is no discrepancy as to what approach the bank is using. So that way, anyone who has access to the valuation policy knows that fine, if a certain product is seen, then this is the valuation guideline which is used. So that's what we call as a valuation policy. Next you have policies which are there for individual risk teams. So you have specific risk policies which are defined for market risk, credit risk, ops risk, maybe even for legal and compliance, etc. Now, these are the types of policies which will be used by the respective teams. So market risk team will look at market risk policies. Ops risk team could look at the policies which are specific to them. So that way, the idea is because these divisions are specialists in their respective domains, that is, market risk specialists understand market risk in and out. So that's why you have people that's why you have policies which are specifically catering to market risk. Similarly, you have something for credit and ops risk as well. Then you have a bank risk policy. So a bank risk policy talks about your counterparties whom you transact with. So maybe one example which comes to our mind is the list of approved counterparties which a bank is trading with. So generally, your most frequently traded banking counterparts, those will figure as a part of your bank risk policy. Because finally, whenever you're transacting with your counterparty banks, these are all risky transactions, right? So something which has to be done only with approved banking organizations. So that way, there is a broad list of banking organizations along with respective limits. So again, don't worry about the limits part. We'll talk about limits later on. But that approved list of banks is something which you'll get to see inside the bank risk policy. Next is a model validation policy. So model validation policy is required because you need a certain approach or a certain standardized way in which your models are going to be validated. Now, why this is required? Because whenever we talk from a modeling perspective, there are two ways to look at this. You have a development and you have a validation. So can you guess why we have these two divisions and why these are independent teams? Why can't they work together? So my first question is, why do we require these two teams? And second is, why are they independent? Would anyone like to try?
So, a model building is a complex process, and the development team and the validation team meet different because if there's a overlap. So, generally, a model development team will also try to validate the model, and the accuracy should not be biased, and that's why these teams need to be separated from each other so that the effective results come out.
Correct. Absolutely. Very good. Yes. So firstly, we are trying, the main idea is we are trying to avoid any kind of conflict of interest there, because if someone has developed a model and if we ask them to validate it, naturally they'll say that everything is correct. Because that is like a human tendency, right? We feel that something which we have done, and that's perfect. There are no two ways about it. So in order to avoid that biasness, as she rightly said, and to avoid any kind of potential conflict of interest, we have independent teams which work on the modeling part. So development guys are those ones who are going to actually develop the model. So any new methodologies or enhancements which come in, that is something which the development team is expected to follow. Whereas you have other team which will do the validation. So validation will ensure that whatever model has been developed has been thoroughly reviewed, because finally that model will be consumed by the business. So before the business can start consuming any model, it has to be given a sign off by the validation team. If the validation team that there observe certain gaps, they are immediately addressed by the development team so that the business gets the correct model to consume. So that's why you have a development and validation team. And I would say these are two teams which always go hand in hand. So if you have a validation team, you'll have a development team and vice versa. So again, two evergreen roles in the industry, I would say. Then role for ORMC, which we call as an Operational Risk Management Committee. So one key activity which I feel which ORMC does is approval of new products, which I mentioned here as well. Because if I take a step back, we had discussed about the fund and investment policy. So we know that the F&I policy has the list of approved products which a bank can trade in. Now, if the front office says that yes, we have X number of products which are transacting, which are already approved by the board. But now we want to transact in this new structured variety because we feel there is a improved business potential and we see consumer demand for this. So now, just because they feel they cannot start trading in the new product, that is something which has to be approved by the board. So before it gets included in the F&I policy, that is, before it gets included in the list of approved products, that has to be presented to the ORMC committee or Operational Risk Management Committee. And it is like a detailed note which is presented. So for any new product which is to be launched, things like what the product is, why do they want to transact on that product, how would they propose to value that product, what are the risk mitigants which can be applied for the product, any kind of collateral schemes which they want with their counterparties, etc. All of these things have to be clearly mentioned and they have to be presented to the Operational Risk Management Committee. Only when the ORMC approves this can a new product get added to the fund and investment policy. If ORMC says that there are certain gaps and we want you to enhance these things, then that product has to wait. The business team has to go back. It has to plug in those gaps, again present it to the ORMC, and only after that will that product get introduced in the fund and investment policy. So that's one of the main roles which our Operational Risk Management Committee does. Then there's also a policy on treatment for illiquid assets. Now, not every asset which the bank holds is liquid. Now, there can be certain assets which are illiquid in nature. So we require some way to address that illiquidity as well. So one of the ways to do that is to have some kind of a capital provisioning, because as I mentioned earlier, whenever we are looking at illiquid assets, we have to look at it from what is the price hit which we are willing to take if we decide to offload the product. So that is what we try to answer through the policy on illiquid assets. So imagine I have a certain bond which is illiquid in nature. If I have to sell the bond tomorrow, how much do I have to pay? Now, why I say I have to pay? Because there will be a cost associated. So one example which I can give is, let's say I have an illiquid asset on the book and I have a model for that. I feel that asset is worth 90 rupees on a face value of 100. But tomorrow, if I go to sell the asset to the broader market, now naturally number of players are less because not too many players are interested in the asset. So they would say that we feel that the asset is worth only 80 rupees. So if you want to transact, then we are willing to trade at 80. Otherwise, we won't trade. So that way, it's like a price hit which the bank will have to factor in. So that is something which we try to address through the illiquidity assets policy. That is, the bank always tries to calculate how much amount of capital provisioning is required in order to answer the question that if the bank has to offload an illiquid asset portfolio or a set of illiquid assets tomorrow, how much is the cost which the bank is willing to bear? And that is a number which gets calculated through this policy. So that policy will define a framework as to how exactly those illiquid numbers are calculated. So we'll talk a bit about how this number is calculated as well when we talk a bit about the capital adequacy framework. This capital provisioning is important. So we'll talk a bit about that at that point in time. So I request you to hold on to this thought for a few sessions. So when we talk of capital charge, we'll cover this illiquidity bits as well. And lastly, you have ALM policy. So ALM stands for Assets and Liability Management. So this is the team which helps in the overall balance sheet management for a company. So you have various loans and advances which a bank does. So that is something which ALM team manages, because finally every bank has a balance sheet which it always tries to strengthen, and that balance sheet management is a day in, day out activity. So various things in order to manage your overall, let's say, a duration gap of your assets and liabilities. That can be one of the examples for ALMs. But again, an important team, and many times ALM teams work very, very closely with market risk, and they help in the overall balance sheet management. So financial statement analysis might have been covered as a part of your earlier course. So bank loan, is it an asset or a liability for a bank?
Asset.
Correct. Absolutely. And any kind of borrowing which we do is a liability. Yes. So that way, I mean, the main role for the ALM team is balancing these two positions. So when we talk from an ALM perspective, there are two sub teams within this. So we have an ALM team which sits within risk, and we have an ALM team which sits within the front office. So risk teams are there for calculating and managing the overall risk, especially things like LCR or NSFR calculation, etc. Again, some things which we'll cover when we talk of banking capital. So we have the risk team and we have front office guys. So front office are nothing but traders who are there to support the overall balance sheet management activity. So these two teams will closely connect with each other because once they work in sync, they are able to manage the overall assets and liability position for the bank in a much better way. So actual trading and any kind of hedging activities which are to be done, that is something which a front office does. Whereas maybe calculating the risk of your book and also ensuring whether your regulatory ratios are being met or not, that is something which the risk team in a bank would keep a track of. So that way, risk and front office teams in ALM, they will work in tandem. So these are a few policies which you'll commonly observe in any bank. So any questions on this?
So,
Mhm.
how is the risk really expressed? Like, is it a percentage of something or?
So one way to define the risk is through limits. So when I say a limits framework, you have a limit which has been set on every asset class or maybe for every trader. So one example can be the beta or maybe the overall duration. Let's say I'm talking from a bank's perspective. So I have duration as a key metric. So I may have a duration limit which has been set at the bank level. So this will be a duration limit for the bank. So it will be a quantified number. And on a daily basis, the duration of my portfolio will be calculated. So the traders and risk managers will keep on monitoring this DP. And the bank needs to ensure that this daily duration of the bond portfolio does not breach this duration limit which has been set. So that way, limits framework happens to be a way in which the overall view of the risk gets converted into a quantitative form or something which can be quantified and monitored for.
So, but actually, so where I'm coming from is, so say a board of director will not say at a micro level ki ha, every asset will have this duration or each asset will have this limits.
Correct.
Where I'm coming from is at top level. When we say I'm a more riskier bank than you are or vice versa, how do they finally express it in terms of overalls?
Correct. So if we talk, so maybe I think there could be, so maybe to address this question, if I give you an idea of how exactly that capital or risk appetite gets decided, so that generally depends on an analysis which the risk team does, and they have, especially when these now this risk appetite has to do with the overall capital adequacy framework for the bank, because every bank has a certain capital charge or capital adequacy which gets calculated. And that way, they also have a view as to how exactly they expect the bank's business to grow. So finally, bank's business has to grow. At the same time, their risk threshold also needs to be maintained. So generally, you'll see that there is and there's a joint effort, I would say, from risk, front office, and maybe from compliance. So they come together and they come up with a certain risk appetite. Now, again, when I say risk appetite, it's a very broad term because there are capital adequacy is just one thing to look at. But other thing is the new business which the bank looks at, because that is something which the traders have better access to, either traders or commercial investment banking division. So if I have to put a quantified number on this threshold, I have to look at these various factors: that am I well capitalized? Is my capital framework robust enough? What are the potential opportunities which the business sees in the near future? Also, what the compliance thinks of these business opportunities, and also do they have any view on the risk framework which is currently being followed? So after combining these 3 or 4 views and maybe something more, we come up with a certain risk tolerance level. So that risk tolerance will get translated into risk limits. And those limits are something which will get adopted on a bank-wide level. So that way, something which has been decided at the top level gets translated into something which we manage on a day-to-day basis.
Right, sir. But like, what I'm trying to understand here is, so is the bank going to say, okay, so since this is X is my turnover, maybe 10% of this turnover can be my risk, or is it time to look at it from a perspective of something else? I don't know. Like,
Correct.
Like, what is a macro policy? I understand how it borrows down to the bottom, but
Correct.
narrows down to the bottom. But what is a macro
Correct.
policy, and how do we discuss that? Is what I'm trying to understand here.
Correct. So I think one very important point is to look from the overall business and risk perspective, because the business of the bank has to grow. At the same time, the risk framework also has to remain in sync with that. It has to remain in tandem. And when we talk from risk, we always talk from the capital perspective or bank's capital perspective. So in case the business, so I would say that it's like inputs which are taken from both the business side as well as risk and compliance side, because new business opportunities have to be pursued, because without that a bank cannot grow. But also at the same time, one needs to decide which are the business opportunities which are to be pursued, and only those which the bank decides to go ahead with, or generally having a rough idea as to what are the nature of activities which the bank decides to pursue going ahead. Because of course, standing at one point in time, we will not know what opportunities will come in the near future. However, if the board has a decent view as to, let's say, these are 3 or 4 categories of opportunities which the bank will look at, then according to that, they will talk to risk and compliance, saying that for such an activity and for maybe this is the expected volume of business which we see. And also, we have to relate this with the current market scenario, because that is also important. So after considering this, they take views from risk and compliance as to, do they think that these, and if we increase the risk tolerance to a certain level such that these newer business opportunities can be pursued, then does it still fit in the overall risk threshold, or is it breaching the overall threshold which the board has approved? So that way they try to maintain a fine balance so that we let the business grow, but at the same time, the overall risk framework of the bank also remains in sync. So I would put it that way. So does this answer your question?
Yes, sir. Yes, sir. But kind of actually.
Okay.
Yes. Yeah, what I was trying to understand is like, so when we say my bank has a risk appetite of so and so crores,
correct.
How do we land at that number is what I was trying to anticipate.
Correct.
Like, key
Correct.
10% of my turnover is my risk appetite. Yeah, 15% of my sales is I don't know. So I
Correct.
was wondering कि कैसे आता है, the number, how does it come from?
So one is definitely through capital charge analysis or capital adequacy analysis, because that decides how much amount of capital a bank will have to keep aside for the increased risk on their books. And next is, and let me see if I can catch hold of any specific technique which is followed. So generally, I mean, what I recollect is earlier we used to link it with the capital charge framework, and generally having an idea or inputs from the business. So that way, I would say it's a slightly subjective way of deciding on that risk appetite. There is no uniform technique which a regulator defines, because this is this is something which every bank will have for itself. But I would say try to think of it from overall capital requirements perspective and the new business opportunities combined with what the current and maybe how the market is going to behave in the foreseeable future. I would say combining these 2-3 points, we try to quantify this thing. Now, let me see if I have a ready methodology for that, but I'll have to check that.
Right, sir. Yeah. Thank you.
Okay. All right. Any more questions for anyone? Okay, good. So we'll stop at this point today. Of course, before we leave, your institute has told me to take attendance. So please bear with me for 5 minutes and we'll take the attendance and then we'll stop. Let me open up the Excel. Yeah, so, okay. So by the way, we are totally 46 of us. Okay. Okay, so Ayush Sharma. So if you're present, you can just say present so that I'll just mark you as present here. Okay. Alisha Gupta.
Present, sir.
Anam.
So it's actually Vidhi. Anam is my surname.
Oh, okay.
Yeah, they've reversed it somehow. Yeah.
Okay. So I'll just, so Vidhi Anam, I'll just change it here. Okay, yeah. Vidhi is there. Anant Jain. Okay. Ajay Topeshwarkar. Sorry, or is it Anish Topeshwarkar? Yeah, I think it's Anish Sopeshwar, sir. Okay. Anjali Sethi.
Present, sir.
Okay. Arshada Imam. Barkha Israni.
Present, sir.
Bhavya Patel. Saloni Bhujbal. Chaitra Tirodkar. Devam Pandey.
Present, sir.
Diksha Kalra.
Present, sir.
Gauraja Nevatia.
Present, sir.
Gayatri Narkede.
Present, sir.
Okay.
Sir, actually, we are using the same laptop, so we are attending
Yeah.
it from the hostel.
Oh, okay, okay. No problem. I mean,
Yeah,
as long
okay,
as
sir.
no issues. Yeah. Govind Mittal. Savan Hake.
Present, sir.
Himanshi Veermani. Okay, Himanshi is present. Okay. Indu. Ishita Saxena. Anika Goyal. Karthik Mittal. Asro L. Lakshya Singhal.
Present, sir.
Mahi Rajawat. Mansi Gupta. Matangi Warrior. Megha Parak. Nancy Alawat. Neha Jain. Pratishtha Pradhan.
Present, sir.
Rohan Bagai. Rohit Poddar. Samida Malik. Shivangi Semwal. Simran Pahuja.
Present, sir.
Okay. Srishti Verma. Tanu Goyal. Tarang Kadian. Kalyani Todkari.
Present, sir.
Twinkle Karnawat. Vaishnavi Shrotriya. Vanishka Jain. Vibhor.
Present, sir.
Vidushi Rana.
Present, sir.
Yash Mehra. All right, great. So thank you so much. Thanks for joining in. And
But this was only one class. There is another class also for financial economics.
Okay. All right. Let me just check. Okay, so this is MSc, IBE, and F. Okay, okay. So I think Shrikant sir might have sent a separate email. List of students for MSc. Yeah, it's MSc International Business. But where is the other list? Okay, okay. Okay, thanks, Avin. So I'll just combine the list the next time. So thanks for, this. I thought this was just one consolidated list. So let's quickly take the attendance here as well. Okay, so that way, cumulatively, we are close to 100, I would say, because financial economics has 50 and the other class has 46.
Yes, sir.
Wow, this is huge. Because generally, I mean, up till now, whatever sessions I've taken, it was generally for 40 students at your institute. I think this time they have combined. All right. Akash Singh. So, I mean, by the way, international business guys, if your attendance is done, you can leave. So, I'll just complete the attendance for financial economics. So, you don't have to wait.
Thank you, sir.
And I look forward to meeting all of you on Wednesday at the usual time. Financial economics guys, please stay. We'll quickly complete your attendance and just 5 minutes more. Akash Singh.
Sir,
Yes.
sir, can you please mark my attendance for I'm Arshita from IBF.
Yes. Okay. Yeah, I will do that. Yeah. Okay. I'll mark it as present. All right. Okay.
Thank you, sir.
Thank you. Okay. So Akash Singh, Achal Jain, Ayush Bhujbal. Sorry, Ayush Bhushan. My mistake.
Present, sir.
Okay. Adesha Hathi. Tejas Akware.
Present, sir.
Okay. Ali Asgar.
Present, sir. You can call me Ali.
Okay. Anjali Garg. Anmol Sen. Arishmita Deka. Avni Mishra.
Present, sir.
Ayushi Rotagi. Sarvesh Bagal.
Present, sir.
Bhavya Dang. Cherry Chabra. Diksha Chauhan.
Present, sir.
Dipansha Singh. Gaurav Kadam. Gaurav Datir.
Present, sir.
Okay. Himanshi Verma. Jaideep Saini.
Present, sir.
K. Ayushi. Krishnakant Shukla. Kriti Marwa. Mansi Singhal.
Present, sir.
Mansimran Arora. Manvi Kukreja. Mihir Sakarikar. Muskan Garg.
Present, sir.
Namrata Gaur. Neil Dhar. Nikhil Agarwal. Prasoon Sharma.
Present, sir.
Pratik Maheshwari. Rachit Tyagi. Rahul Ghosh.
Present, sir.
Rahul Giri. Rahul Goswami. Rajaditya Singh.
Yes, sir.
Rashi Jain.
Present, sir.
Okay. Rishabh Kothari. Ruma Keshri. Sahaj Manocha.
Present, sir.
Samiksha Chopra.
Present, sir.
Sharanya Bhattacharji. Shubham Jain. Shubham Kumar.
Present, sir.
Someshwar Verma.
Present, sir.
Suti Mehrotra. Sanika Thakur.
Present, sir.
Okay. And Vinay Pawar. Okay.
Sir,
Thanks, guys.
Sir,
Yeah.
Gaurav Kadam. Missed my
Uh,
attendance.
Okay. Okay. I think I called out your name, but maybe voice might not. Take
Yes.
Gaurav Kadam. There are two Gauravs, I think.
One is Datir and one is
Yes,
Kadam.
yes. Yeah. So I'll mark Kadam as well. Yes. All right. Yeah.
Thank you.
Great. Thank you so much and have a good evening. And I'll see you guys on Wednesday at our usual time, morning, 9:50.
Sir, Sharanya was present. She just left the meeting like 3 minutes back.
Okay. Okay. I'll mark her present. No problem.
Yeah. Thank you so much, sir. See you on Wednesday.
Thank you. Yeah. Bye-bye. Good night.
Excuse me, sir.
Yes.
Sir, this is Archer, sir. There is some issue, so I couldn't.
Okay. Okay. No problem. I'll mark you present. Yes. I saw your message just now. Yes. Yes. Yeah.
Okay, sir. Thank you.
Thank you. Thank you.